Hello friends, the topic for today's discussion is mergers and acquisitions. In today's fast-paced world, everyone is looking for faster and cheaper ways of doing things better. With the increase in business competition and the economy heading towards globalization, every company has to look upon their survival. In 20th century, only financial management was enough to survive or to grow. But if the company wants to become compatible with today's ultra-modern world, it must use financial management as well as strategic management. Nowadays, the usage of some new strategic tool like mergers, acquisitions, takeovers, contraction strategies, corporate control have become an integral part of new strategic paradigm in the corporate world. These methods are played as important role in achieving external growth of a number of leading companies the world over. There are some confusion and disagreements regarding the precise meaning of terms related to mergers and acquisitions. Let us clarify them. Let's start by understanding the term mergers. According to the Oxford Dictionary, mergers mean combining of two companies into one. In pure sense, a merger happens when two firms, often of about the same size, agree to go forward as a single new company rather than remain separately owned and operated. However, in practice, actual mergers of equals do not happen very often. That is the reason the meaning of the terms related to mergers are varied according to the deal's terms. The term merger refers to a situation where one or more existing companies combine their business operations to form a new company. The existing companies merge their identities into new merged company by transferring all their assets and liabilities. The shareholders of the existing companies receive shares of new merged company in exchange for the shares held by them as per the agreed exchange ratio. Let us understand what's acquisition. The term acquisition refers to acquiring of effective working control by one company over another company, where acquiring company takes over the ownership of other companies and continues their operation with its own operations. Acquisition may be defined as an act of acquiring effective control over assets or management of a company by another company without any combination of businesses or companies. A substantial acquisition occurs when an acquiring firm acquires substantial quantity of shares or voting rights of the target company. Thus, in an acquisition, two or more companies may remain independent, separate legal entity, but there may be change in control of companies. An acquisition may be either friendly or hostile acquisition. Let us first see friendly acquisition. Friendly acquisition takes place when the management of acquiring company and target company mutually and willingly negotiate or cooperate with one another. Hostile acquisition. Hostile acquisition takes place when the management of acquiring company forces target company unwillingly to be bought the business, where generally target company may not agree with the tender offer or may not have a prior knowledge of the offer. A comprehensive list of motives propelling mergers and acquisitions activities is although difficult to draw up. The usual motives or reasons behind the strategy adoption of mergers and acquisitions are here. The first term is economies of scale. In a layman's language, more the products, more is the bargaining power. This is possible only when the companies merge or acquired. It is same as eliminating duplicate departments or operations and combines them into one, thereby to lower the product cost and increase the product range of the company so as to increase the profit. Let's look upon acquiring market share and market power. This motive assumes that the company will be absorbing major competitors by using the techniques of mergers and acquisition and capture their product market by market shares and market power. The next in line is technological motive. Technology plays an important role as a driver in mergers and acquisition strategy. Generally, mediocre or inferior technology companies prefer to merge with improved or superior technological company. The next is corporate synergy. Corporate synergy works on the assumption that the combined firm is more valuable than the sum of the individual firms. It suggests to use complementary resources available by merging or acquiring the company in such a manner that it may lead to generate either in the form of revenue enhancement or in the form of saving cost. Let us see the tax avoidance. Many times, mergers and acquisitions techniques are adopted to save the tax. When the profitable company acquires the business of loss-making company, it is a planned merger to set off and carry forward the losses of loss-making company against the profits of the profit-making company. Here the next comes geographical or other diversification. Geographical diversification is one of the potential reasons of the mergers and acquisition. Sometimes merger takes place either to reduce geographical boundaries or to increase distribution channel to push common sales of the product. Next is growth. Mergers and acquisition strategy is a demonstrated tool to grow the company externally. It provides ways to throw off cash flows beyond its internal needs and also creates wealth for the business. Other than all, there are some other reasons too. To improve a company's standing in the investment community, as bigger firms always take less time to raise the capital than smaller ones. To increase promoters' voting power, to eliminate the takeover threats, to enhance the earning per share of the company, etc. Now, let us classify the mergers and acquisitions by its type. The first is horizontal merger or annexing merger. When two or more companies produce similar product in the same industry and they merge their business, it is known as horizontal merger. In this case of merger, companies which are in direct competition with each other combine their operation to eliminate or to reduce the product market competition. The primary reason for acquiring or merging of related businesses is the willingness to price cut economies of scale in production, resource utilization, market capturing or to create monopoly of the product. Kindly look at the graph to understand the term similar industry or horizontal merger. Horizontal mergers produce two consequences that do not arise in either vertical or conglomerate mergers. It reduces the number of firms competing in the relevant market and it eventually results into market concentration. The only noticeable limitation of this type of merger is that the consumers may pay higher price for the product or services because of reduction in competition. The second type is vertical merger or streaming merger. In the case of vertical merger, a company acquires its upstream or downstream units. Vertical merger is a combination of two or more firms involved in different stages of the production cycle or distribution channel within the same industry. When company merges its operation with its supplier company, it is called backward or upstream merger, and when it combines its operation with the customer company, it is called forward or downstream merger. This is why vertical merger is also known as streaming merger. The main purpose of backward vertical integration is to reduce cost of the inputs and to gain control over the production process. And primary aim of forward vertical integration is to save distribution and marketing cost by delivering the final product straight to the customers. Let us understand vertical merger by graph shown here by taking example of companies involved in different stages within similar industry. In this graph, if weaving company acquires the business of cotton spinning company, it is known as backward vertical merger, while if weaving company merges its operation with the business of bleaching and finishing company, it is called forward vertical merger, conglomerate merger or diagonal merger. Conglomerate merger takes place to achieve growth through diversification strategy. It is a combination of firms engaged in different or unrelated product lines of activity. Such type of merger takes place to add new products having no relationship with the company's current production line, technology or markets. Allocation of the capital amongst different business entities, increasing the range of product lines, to save the tax, to provide demonstration of management power are the potential motives of the conglomerate merger. The next is concentric merger. When company concentratively thinks to merge its operation with the company having more technological or marketing synergies for their existing product, it is a type of concentric merger. In concentric merger, company can also use any strategy from similar industry merger or diversification merger. Most of concentric mergers have been seen in the form of hostile takeovers. Such mergers did not last long due to the second oil crisis in the year 1979 and the deep recession of early 1980s and corporate raiding. The last one is demerger. Corporate demerger is one of the several ways through which a firm may divest a division and improve its focus. A demerger is a pro rata distribution of the shares of a firm's subsidiary to the shareholders of the firm. There is neither a dilution of equity nor a transfer of ownership from the current shareholders. After the distribution, the operations and management of subsidiary are separated from those of the parent. In American English, this process is termed spin-off. In British English, it is known as demerger. Before moving on to the next topic, let us quickly look on the benefits and limitations of the merger and acquisition. Benefits of merger and acquisitions. The deal of merger and acquisition may be beneficial to both the acquirer company and the merged company in terms of either financial benefit or non-financial benefit, or may be combination of both. But the primary benefit of merger and acquisition has been always obtained with the main object of a deal. The significant benefits of the merger and acquisitions are: it uses the economies of scale, which reduces unit cost. It generates greater market shares for horizontal integration, which means the business can often charge higher prices. Company may reduce tax liability if loss-making business is purchased. It spreads risk into many products if new product is added in product line. It helps to reduce competition if a rival is taken over. Acquirer company may be benefited by the ready factory or refinery for its raw material, more labor power, ready market for the products, etc. It is easier to raise money if companies are merged together and make a large business. It can help to improve operating margins and efficiencies of employees as well as management. Company can increase income with proportionately less investment and time. Deal is also beneficial sometimes to shareholders of merged company if merged company is making a loss. Let us see the limitations of mergers and acquisitions. Due to business expansion, sometimes business becomes too large, resulting in higher unit cost, which ultimately leads to diseconomies of scale. Conglomerate merger may create cultural diversity and reduce the effectiveness of the integration. Acquisition may make some workers redundant, especially at management levels. Diversified mergers may create conflicts of objectives between different businesses. Horizontal merger creates monopoly, which results into elimination of healthy competition from the market. The next is concentration of economic or market power splits into many products if new products are added to current product line. In case of hostile acquisitions, unwillingness may affect the productivity or efficiencies of acquirer company. Because of merger and acquisition, the size of the business is increased. It may ruin the business of small and medium enterprises. Let us move on further with the discussion of what is the financial considerations in case of mergers and acquisitions. Consideration is something that have monetary value provided by one party to another party in exchange for a product or services provided. It may be in the form of cash or payment in kind of cash. In case of purchasing a product, price paid in exchange for transferring ownership of goods is called consideration. In case of receiving any services, payment of bills or fees is a consideration. In case of buying an insurance policy, insurance premium paid is consideration. In the same way, while purchasing a business or part of business, purchasing company has to pay a purchase consideration to its vendor company. Financial consideration in case of merger and acquisition means the payment made by acquirer company to shareholders of the merged company. Acquirer company generally prefers to pay the consideration in the form of the first is by issuing equity shares, preference share or any secured debt instruments of acquirer company, by payment in cash or bank, and by the combination of any of the above. Before we will end our discussion of today's last topic, financial evaluation of mergers and acquisitions, it is necessary to focus on the technical difference of the valuation and evaluation. Valuation is a process of estimating the value for the exchange of anything having monetary worth. It is generally adopted before making any decision and consideration is paid only after the valuation, while evaluation refers as an assessment process of examining or judging the decision in a precise manner that is already taken. It is generally adopted after making the decision. In case of merger and acquisition, valuation is the process which is carried out to estimate the exchange value for financial assets or liability by any of the following methods: book value, replacement value, market value, present value, asset based valuation, relative valuation, dividend discount model or by discounting factor model. Though the significance of the methods of evaluation for merger and acquisitions is equally important as valuation methods, but less attention is given to evaluation by the company. Finally, we can finish our today's session with the object of spreading awareness of using such evaluation methods for merger and acquisition. The first is trend analysis of share prices. It is a simple financial evaluation in which acquirer company can examine the trends of share prices before the merger and after the merger, and also can compare them to a reference group of corporations in similar industry to find out if the performance has improved or not. If company finds that the line of trend analysis chart has gone upward after the merger, it simply means a good merger deal. The next is ratio analysis. Ratio analysis is most widely used and a very well known tool for financial analysis. It is the relationship between two related items which is expressed in simple mathematical form. It is the best indicator tool to measure the financial performance of a company. Acquirer company can analyze the merger deal by comparing the average ratio of pre-period with the average ratio of post-period. The next is Dupont Analysis. The Dupont Analysis is the precise form of ratio analysis where the list of predefined ratio is given and the pre-merger and post-merger averages for such a set of following key financial ratios are computed and compared with difference to evaluate the merger rates. A set of key financial ratios and the formulas are shown here. The next is cost-benefit analysis. The main object to evaluate the merger deal is to know the net economic advantage received by deducting cost of merger from benefit received by merger. To calculate cost-benefit analysis, following steps can be used. Cost is considering paid to target company minus the value worth of target company. Benefit is combined value worth of target company is more than separate value worth of both. When benefit is more than the cost, it is considered as a great strategic merger deal. The last is statistical analysis by t-test. The pre-merger and post-merger averages for a set of key financial ratios were computed where the year in which merger deal occurs is denoted as base year. For the years prior to a merger, the performance of the acquiring firm alone are considered. For post-merger years, the combined performance of firm is taken. The post-merger performance is compared with the pre-merger performance and tested for significant differences using paired t-test. To summarize at the end, we can now understand the terminology, types, valuation, and also can evaluate any mergers or acquisitions deal from our discussion. From the objectives and advantages, we can also understand the increasing importance of mergers and acquisitions as a well-known expansion strategy of corporate restructuring.